And welcome back to another recorded lecture. This one, we will be wrapping up Unit 4 with what I call the Monetary Policy Addendum. I'm your host, Mr. Kamos, and today we're going to be tying the loose ends. We're going to be filling the gaps with what I think is the most fun unit of AP Macros, the most interesting. It's also the most challenging. And we've talked about all the things that I'm going to mention in the addendum to the unit, throughout the unit. But today we're going to spend a little time diving a little deeper to make sure that you know everything you need to know about monetary policy and the Federal Reserve and central bank. Before we do that, I'm going to remind you to make sure you are actively listening to this recorded lecture by taking notes and pausing the video whenever you need more time to digest content. And without further ado, we will begin. And so you see here, I found the most panicked, confuzzled pictures of our most recent two chairman and chairwoman of the Federal Reserve. On the left is Jerome Powell, who was appointed to the Board of Governors by President Obama and then made chairman by President Trump and approved by the Senate. And then his predecessor, Janet Yellen, was also appointed by President Obama, but President Trump did not reappoint her. And so she later became Treasury Secretary under President Biden. But I'm mentioning them here because a lot of times people forget that even though they are the face of the Federal Reserve and they are the voice of the Federal Reserve to the public and to markets, they are not the Federal Reserve in and of themselves. They are just representing the greater system, and they are a sitting member on the FOMC as governors of the Board of Governors in their own right, but they are not the ones calling all the shots. It is a committee that you know very well, the Federal Open Market Committee, that is making all the decisions. And so some of the things we're going to be talking about today, they are the best example of these things, but they are not, the only ones. And with that, now we can outline the addendum. And an addendum, in case you don't know, is just something added to the end of something. So we're just adding a couple of things to the end of Unit 4. And so we're going to be talking about central bank independence and its importance for a country, for an economy. We're going to be talking about something called forward guidance, which is how the Federal Reserve and central banks around the world communicate policy to the public. We're going to be talking about fiscal policy and monetary policy interplay, where the interactions between actions of the government and actions of the central bank and how that impacts the economy. And then we will be wrapping it up with problems associated with monetary policy. And so we will go through this as quickly as possible. So I'm going to start with a couple of pictures from the past almost 2 decades now of crises that have occurred around the world, and you've probably heard of some of these. Some are more recent than others, but I'm going to start with this picture of children in Zimbabwe on the side of a road, and right before this picture was taken, a truck had just rolled by carrying corn, and some of the corn had spilled off of the truck and onto the road, and the kids were picking up the corn because they were starving. And so this crisis occurred back in 2008. But there's another one that occurred 10 years later in Venezuela, very close to here. And this was a humongous crisis of astronomically terrible proportions, where literally thousands and thousands upon thousands of people were crossing the border every day into Colombia. And they were crossing, some of them, to migrate permanently. And as you know, a lot of Colombians came to the Dominican Republic. Other Latin American countries received a lot of Colombian migrants. But even more people crossed the Venezuelan border every day into Colombia just to get food, because they literally could not find any in Venezuela. Venezuela, which used to be back in the 70s, 60s, one of the most wealthy nations on earth, with one of the most prosperous and well-educated citizenry in the world. So that happened in 2018, and it's still happening to a certain extent. And then more recently, after the pandemic in 2022, There were terrible, terrible protests in Sri Lanka, which fortunately have abated. But these protests were due to food and fuel shortages, specifically um, very, very scarce fuel, really the economy ground to a halt in Sri Lanka in 2021, 2022. And then in 2021, right before that, there was a terrible bout of protests in Argentina. And this is a tent city of protests in Buenos Aires as a result of inflation. Terrible, terrible inflation in Argentina, which, of course, there had been inflation in Argentina for years before, but it really hit a tipping point after the pandemic. And then Lebanon in the same year, 2021, again, really bad food shortages. I mean, to the point where people were storming supermarkets and people could not even buy bread. There was no flour, there was no food. And terrible, terrible shortages. And so my question, after showing all these images, what caused all of these crises? You know, you're probably thinking, looking at the shortages of fuel and food, you know, was it famine? Was it a natural disaster like an earthquake or a hurricane? Was it, a war? The possibilities are endless. But in reality, all of these crises were man-made. They were completely man-made by policymakers in offices in all these countries. Policymakers making decisions about the money supply and monetary policy and central banking. And they were terrible, terrible decisions. And so here's the result in a couple of the countries. Zimbabwe. You see, the graph is for the money supply. And starting around 2006, the money supply began to increase. And after 2006, it continued to rise to the point where today there is still so much hyperinflation in Zimbabwe that nobody uses the Zim dollar. Nobody uses the old Zimbabwe dollar. Now they use the US dollar. They have dollarized as a result of the growth of the money supply, of hyperinflation. In Venezuela, we saw the same thing in 2010 when Maduro took power. Terrible, crises developed as a result of inflation. Inflation caused by the government increasing the money supply, bad monetary policy as a result of an economy based solely on oil. And Venezuela still today has not recovered from this bad mismanagement of their money supply. And then we have Argentina, same story. Looks different, same story. Today in Argentina, the inflation is very, very high still as a result of the growth in the money supply. And so we've learned about this. We've learned about the quantity theory of money. We've learned about Milton Friedman and how he said that every rise in the price level at the end of the day results from an increase in the money supply. And it is the most egregious mismanagement of public policy that a country can experience and be the victim of. Mismanagement of monetary policy and the money supply. And it's interesting, history does not repeat itself, but it rhymes. And it makes this topic so salient, so important, because the same mistakes keep getting made all around the world at different times, where countries, central banks, and politicians increase the money supply for various reasons, and the end result is always economic catastrophe, inflation, that impacts the lives and the standards of living of everyone, most especially the average citizen. But everybody is affected negatively by economic unrest and man-made economic immiserization, which is the result of the money supply increasing. And this brings us to our first topic, which is central bank independence. And central bank independence is of the utmost importance because in almost all of these examples, central bankers made bad policy decisions only because of a lack of independence, where sometimes, central banks have to make unpopular decisions in order to prevent the price level from rising, in order to prevent rampant inflation. And yet, if politicians start interfering with, you know, economists and technocrats and bureaucrats in the central bank and their decision making about policy, it can lead to very, very bad outcomes. And so politicians are going to use sometimes, and have used throughout history, the power of money creation that a central bank has, that a central bank is created for. And they're going to do this for personal gain. They're going to do this to maintain power. They're going to do this to win re-election, or they're going to try to boost the economy for whatever reason, for whatever short-run gain that they might want to experience politically. But it will always have a detrimental long-term consequence, and that long-term consequence is hyperinflation. And so it is central bankers' responsibility to advocate for independence so that it gives central bankers the room to make the uncomfortable decisions, right? To make the decisions that are difficult but right for society, for the economy, for the people. And that is very, very, very important. I cannot impress upon you the importance of that enough. This, like I said, there are countless examples of this. All the examples I just listed are examples of a lack of central bank independence. One of the most egregious examples of this has been President Erdogan in Turkey. And President Erdogan has been in power for a long time. Some people even debate whether or not he's actually a president because he has quite a lot of power. But notwithstanding all of that, his interactions with the Turkish central bank have been so chaotic and so volatile and so much that I have lost count of how many governors of the Turkish central bank there have been under Erdogan. I remember back in 2021, 2022, he went through 4 governors in the time span of like a year and a half. And the reason why was because there started to be terrible inflation in Turkey after the pandemic. It got up to 15% or so, and central bankers did what central bankers know they should do. In Turkey, the central bankers began increasing interest rates. And Erdogan did not like this because it's unpopular, right? It's unpopular to increase the cost of borrowing. It's unpopular to make people pay more for loans, and it increases the cost of everything, for consumers and firms to borrow. And so politically, Erdogan had an incentive to interfere with central banking and to interfere with the decision-making of monetary policymakers. And so he just fired whatever governor wouldn't keep interest rates low. And then eventually, he won re-election, and he has let now a governor, begin raising interest rates. But it was at a terrible cost because inflation rose to nearly 90% annually in the post-pandemic years, and it still is not really going down. Right, in interest rates in Turkey at the time of recording this, they're around 45%, between 35 and 45%. That is extremely high. Imagine trying to borrow money to expand a business, or to go to university, or to buy a house. Right, you can't pay an interest rate that high, and so there are terrible costs to mismanagement and a lack of independence. This is an interesting graphic, and it shows central banks between 1955 and 1988 and their relative independence versus average inflation. So we see average inflation on the y-axis and the index of central bank independence on the x-axis. And you see lots and lots of countries that had less central bank independence had higher inflation rates. But the countries on the far right, mainly the US and Switzerland and Germany in this period, they generally had more central bank independence, and so they had less inflation. Of course, this is average between 1955 and 1988, and we've already learned about the example, we will learn about the example of Nixon interfering with the Federal Reserve under Arthur Burns, one of the most egregious cases of political interference in the Federal Reserve, at least in the United States. And it definitely was not the norm in U.S. history, in the history of the Federal Reserve. And after Nixon and Arthur Burns, starting with Paul Volcker under Jimmy Carter and then Reagan, central bank independence and its importance to the macroeconomy really was recognized, and that has been recognized ever since. And so if we relate this concept of independence to the Federal Reserve, I know that we've talked about this a lot, but in the context of independence and its importance, the Federal Reserve was created to try to prevent political interference in monetary policy, even back as far as 1912, 1913, when the Federal Reserve was created. They knew they didn't want politicians to interfere with the decision-making of economists at the central bank. And so the Federal Reserve is designed to prevent this as much as possible. The Board of Governors serves staggered 14-year terms, which are very long. They are appointed by the president and confirmed by the Senate, but 14 years is much longer than a 4-year presidential term, right? Or even a 6-year term for a senator in the U.S. And so that's one safeguard. Another one is that the Fed's budget is not set by Congress. It comes from the Fed's operations. And so this is significant because the Fed doesn't make a profit, right? They're not trying to make a profit. They don't need to worry about, Congress setting a budget or Congress interfering with the budget of the Fed, because the Fed handles that all on their own. And then power is widely distributed in the Federal Reserve System. And of course, this has its history going back to Americans, red-blooded, corn-fed hatred of banks and distrust of banks. And if you've studied U.S. history, you know that's the case, going all the way back to the Revolutionary War and with Jefferson and afterwards with Jackson. But when the Federal Reserve was created, they purposefully divided power between public and private spheres. And so the Board of Governors is the public face section of the Federal Reserve, body of the Federal Reserve that is directly connected to Congress and the president, the politicians that are voted into power by the people. But then the other part of the Fed are the regional Federal Reserve banks, which are run as private businesses with a board of governors, just like a company, where they elect a private individual to serve as the regional Fed president. So another part of this, if we think about central bank independence, the central bank acts as the lender of last resort. They perform open market operations. They have the administered rates of interest. These are the tools in the ample reserves framework, that IORB, the interest on reserve balances, and the discount rate. Those rates of interest are set by the FOMC. Politicians have no say in what happens to those two interest rates, and through the administration of those two interest rates, the Federal Reserve adjusts the Fed funds rate and adjusts the quantity of reserves in the banking sector through open market operations. And that is one reflection of central bank independence. But coordinated expectations is a fourth tool, if you include open market operations as a minor tool. Coordinating expectations is a fourth tool that we haven't discussed. And that's because it's nebulous. It's hard to define exactly how this works. But this is called forward guidance in central banker speak. And we're going to discuss this in a little more detail because it actually plays a huge role in setting expectations between all the economic agents in the macroeconomy, with firms and financial institutions and consumers. Everybody listens to the Fed. Everybody tries to understand what the central bank is going to do because they know that the central bank is powerful. And so we call this coordinating expectations. And the Federal Reserve is very, very deliberate with this. We've discussed monetary policy case studies already and historical examples. It used to be that the Federal Reserve never spoke to the public. They never spoke to markets, right? They released very, vague statements that were difficult to understand. And they did this intentionally because they didn't want to steer markets. They wanted the free market to operate. They wanted financial markets and product markets and factor markets, all of them, to function on their own without interference. And so we see, as we go through the history of the Federal Reserve, they've learned that there's actually quite a bit of power in what is called Fed speak. And so a lot of what happens in the economy are expectations, right? If people think there's going to be a recession, and everybody thinks that, and every business makes decisions because they think there's going to be a recession. Consumers make decisions, and savers and financial institutions, there's going to be a recession. If people think inflation is going to continue, businesses make decisions, consumers make decisions, banks make decisions, then inflation will occur. And so the Fed realized this, and starting in the 1970s, but really in the late 1990s under Alan Greenspan, and then especially during the GFC, the global financial crisis under Ben Bernanke, the Fed realized the importance of speaking to the public. And under Jerome Powell, it has taken on even greater levels, right? Jerome Powell is probably the most transparent Fed chairman in history. So let's define forward guidance. Forward guidance is when the Fed uses communication to manage public expectations on economic matters. And so, of course, we say manage, but they're not really in control of the public, right? Everybody thinks independently. At least I hope all of you are thinking independently. But the Fed's communication is, sort of nudging people in a certain direction, right? And they can be quite deliberate if they wanted to, but generally they're not. Generally they're very vague. And that's why I have communication in parentheses there. Or quotations, excuse me, not parentheses. Because it's communication, but it's very indirect. It's very obtruse. And they try to obfuscate, things in a way that makes them very, hard to discern meaning from. And they do this very intentionally. But they also do it in a way where they want to impart enough meaning so that they can achieve the outcome that they want, to sort of guide all of the agents in the economy, the financial markets, firms, consumers, everyone. And so this is effective because everyone knows to pay attention to the Fed, right? Everybody knows the Federal Reserve is powerful. Everybody knows around the world that the FOMC is one of the most powerful deliberating bodies in the world. And so they listen. And they have listened for all of the Federal Reserve's history whenever they speak. But now that the Fed is speaking more, they listen more. And the Fed plays a more active role in steering all markets. And this is where central bank independence becomes really important, because in order for this to work, people have to believe in the central bank, right? People have to believe that the Federal Reserve is credible, right? That they are truthful, that they have society's best interests at heart in their decision making, that the Fed is independent, and that no President Bush or Obama or Biden or Trump or whoever has a say in monetary policy, right? People have to trust that monetary policy is independent. And if there's any doubt in the Federal Reserve's independence, or there's any doubt in the Federal Reserve's ability to actually maintain their dual mandate of maximum employment and stable prices, if there's any doubt that the Federal Reserve is not acting in the best interest of society, then that complicates the task of monetary policy incredibly. And so part of this Fed speak, that part of the goal is to assuage any fears that the Federal Reserve doesn't have society's best interests at heart. And this is very, very important. And so now let's talk about the art of Fed speak. The Fed is going to speak. Jerome Powell gives a press conference every 8 weeks. He goes before Congress multiple times a year in hearings where they bombard him with questions, and he answers them as best as he sees fit. And so they have a lot of communiques, right? The Federal Reserve regional presidents, if you follow the business news, they'll come out and they'll do their own Fed speak, right? And they call it, the talking heads call it Fed speak. Whenever a president comes out and says, okay, Federal Reserve Bank of Atlanta president, they say that this is happening with inflation in the Southeast and blah, blah, blah. Or maybe the Federal Reserve Bank of San Francisco's president comes out and has an interview with a think tank or, with Bloomberg or whatever. When these things happen, people listen because this is all Fed speak. But they can't be too forthright, right? They can't be too explicit because if the Fed says something, people are going to believe it. And then it becomes a self-fulfilling prophecy. Right? It's sort of like inflationary expectations, right? If all the firms and all the banks and all the businesses and all the consumers in the economy believe that inflation is going to rise next month, inflation will rise next month, right? That is, behavioral economics, which is very fascinating. It's interplay with monetary policy. And it's, same thing with a recession, right? If the Fed came out and said the economy is going to have a recession, literally, there would be pandemonium. Everybody would panic. The economy would indeed go into a recession practically immediately, right? Financial markets would collapse. And so the Fed can't just say what they think is going to happen, right? Even though they do think things are going to happen, they have forecasts. They have models that they look at, and they're looking at all the anecdotal data and all the indicators, all the statistical data. But they're going to be very dry and very vague. And they're going to speak about things in a very technical manner, which is called Fed speak. Okay, and we've already looked at a little bit of Fed speak when we talked about upside versus downside risks in regards to the FOMC and the Beige Book. But now we're going to just talk about this sort of on a macro level, how it impacts the macroeconomy and monetary policy. And so by speaking in this manner, by being technical and vague and not saying exactly what they mean, the Fed is able to retain some flexibility, right? They're able to communicate to the public and to steer the public's expectations for the future, to coordinate them without creating overreaction, without creating panic, without controlling the markets. And that is very, very important because that will allow the Fed to make the decisions that they need to, which some of them might be very well unpopular and difficult for the economy. And so what I've done is I consulted ChatGPT because I wanted to see how ChatGPT could write like the Fed, or if they could. And ChatGPT certainly can. It's very interesting. They must aggregate all of the Federal Reserve documents and all the things. But what I did was I took lyrics from T-Swift. So hopefully you'll pleasure me in just seeing this as an example of what the Federal Reserve literally does, right? If we think about T-Swift's lyrics as being like as blunt, as easily understandable, as approachable for the public as possible, Fed speak is certainly the exact opposite. So here's one. Taylor Swift says, "We are never, ever getting back together." But the Fed would say, "Upon careful analysis of historical data and current indicators, the committee has reached a decision that the conditions for re-engagement are structurally unsound. As such, the long-term outlook indicates low probability of policy reversal towards reunification." Now, that is perfect Fed speak right there. Literally saying the same thing, but wordy, vague. Most people would listen to this and they wouldn't really be able to discern exactly what the Fed means. Here's another one. T-Swift would say, "The road not taken looks real good right now," but the Fed would say, "The pathway diverged from, which was not initially chosen, currently appears to possess a notably favorable appeal within the current economic context and policy considerations, reflective of evolving market dynamics and prevailing macroeconomic conditions." Well, there you go. Here's one more. Don't treat me like some situation that needs to be handled. But the Fed would say, refrain from regarding my persona as a mere circumstance necessitating management or oversight within the operational framework, but rather acknowledge the complexity and nuance inherent in my existence with the broader economic milieu, warranting a nuanced approach informed by comprehensive analysis and understanding. That is Fed speak right there. And so hopefully you understand what Fed speak sounds like, what it looks like, but also why it is important and why the Fed doesn't. So now we can shift gears, no pun intended, but we can talk about the interplay between fiscal and monetary policy. And this is sort of summarizing 2 units. Like we're looking at like 4 months of content that we're summarizing here. And it's a lot, right? We've learned about a lot. We've learned about Congress and the government and how Congress can use the federal budget, the budget of a country, through taxing and spending to influence aggregate demand, to influence output through the multiplier effect, and then consequently how the government can impact real interest rates by borrowing and the issuance of bonds, and how the government can crowd out private individuals from loanable funds, resulting in an increase in real interest rates. And then we learned about how the central bank manages monetary policy, and through the management of administered rates of interest in the ample reserves framework, they can affect interbank lending, which affects the nominal interest rates in the economy in the short run. And all of these short run changes in nominal interest rates impact disposable income, impact consumer and business decision making through aggregate demand, which will then lead to changes in real GDP and changes in output. And so we've used all these different graphs, ADAS, the Phillips curve, money market, investment demand, the reserve market, the loanable funds market, to show these changes in price level and real output and unemployment and inflation and nominal interest rates and quantity of money and all these things. And so now what we need to do is we need to sort of put it together. And so we've got these 2 sets of policy performed by 2 different groups of people. But what you must understand is that oftentimes they are in conflict, because what Congress wants to do is not necessarily what's good for the economy. And we are going to assume that in 2020, whatever it is, the Federal Reserve and central banks are trying to do what is best for the macroeconomy and what is best for the dual mandate for the Federal Reserve and what is best for the macroeconomic indicators in people's economic lives. So with that said, we can talk about the interaction. And so both sets of policy could be used to stabilize the economy, to get the economy back to full employment output, or they could be opposing forces that could create uncertainty. It could create indeterminate or conflicting outcomes. And you're going to see this a lot. AP asks questions about the interactions between monetary policy and fiscal policy, and you really have to think about our basic indicators, GDP, unemployment, inflation, and interest rates, right? What is happening to all of these things? How are they related? How can one decision by Congress impact the ADAS model, and how can one decision by the central bank at the same time have an opposite or similar reaction? And so there's no easy way to do this, right? You just have to think about the graphs. You have to think about policy. You have to think about what they're doing. Is it expansionary? Is it contractionary? Are they in alignment or are they in conflict? And so that, you could draw graphs. We could do this together. We're not going to do it because it's a recording, but in class, we will probably draw a couple of graphs for review where we see, okay, fiscal policy could be expansionary at the same time as contractionary monetary policy. And then we draw ADS, and we can't actually draw one model, right? Because the outcome is indeterminate. And so when we look at the indicators, there are different models that you can think of to try to help you think of the impacts of these policies. ADAS and the Phillips curve are one set. If we use those 2 graphs, we can analyze changes in real output, price level, and unemployment. If we use the money market or the reserve market or investment demand, we can look at changes in interest rates, nominal interest rates in the short run. We can look at changes in investment. We can look at changes in economic growth if we're referring to the real interest rate. And that I have an asterisk by that economic growth because in a few classes we will be discussing economic growth in the long run, which is connected to the loanable funds market, but we'll look at that later. And so I have the loanable funds market there because here we can analyze the impacts of government debt and it crowding out, nominal interest rates versus real interest rates. We can look at how real interest rates will change, how it will impact investment in the long run, how it will impact economic growth as a result in the long run. And so we can look at all of these things and see how they are interconnected. And so I recommend that you just take this time to think about a couple of examples where the central bank does one thing, Congress does another. We've got fiscal and monetary policy at the same time, like in the real world. What conclusions can we draw, right? Or are things uncertain, right? Are things indiscernible from the policy actions? And then the last thing that we need to cover very quickly are the problems with monetary policy. And so there are problems. Just like we had problems with fiscal policy, there are problems with monetary policy or limitations. The first one is time lag, right? So when we do the FOMC simulation and when we look at the data the Federal Reserve is looking at, they're looking at inflation data, they're looking at GDP data, they're looking at unemployment data, but it's all already happened, right? It's old. Right? They don't know exactly what's happening on the ground right now. That's impossible, unfortunately. If they did, things would look very different. But there's also a time lag with monetary policy in and of itself. If the Federal Reserve adjusts the administered rates of interest, for instance, if they decrease the IRRB and they decrease the discount rate to try to decrease the target Fed funds rate, and they're decreasing the target Fed funds rate in order to try to increase interbank lending, and then if banks are lending and borrowing more between themselves, then it would lead to more borrowing by everybody else in the economy because all of their interest rates would go down. That whole process of interest rates changing across the economy, that takes a lot of time, right? It doesn't happen overnight. And so when the Federal Reserve makes a decision about the Fed funds rate, they can't just think about, okay, what is this going to look like tomorrow? They're making a decision about the target Fed funds rate, about monetary policy, and forecasting, okay, what is this going to look like in a month or 3 months or 6 months, okay? And then what are we going to have to do at the next FOMC meeting? And so this takes time. Now, even with all of that said, generally the Fed is going to be faster, and central banks in general will be faster than governments to react to changes in the economy, because the Fed doesn't have to go through a legislative process, right? The Fed isn't answerable to voters, and the Fed doesn't have to corral 500 something different House members and 100 senators in order to vote on a bill about spending that will impact the budget, that will impact aggregate demand. They don't have to do that. But it's still going to take time, right? The FOMC's decisions are faster, but they're not overnight in their implementation. Long-run effects versus short-run policy. Now, this is an interesting one historically, because if we look back to the 1990s or so, inflation was tamed under Volcker in the 70s and early 80s. Paul Volcker raised interest rates to 15%, close to 20%, in order to get, at the time, what was very high inflation down. And it worked. And inflation got down. And then interest rates were kept very low for a long time. The Fed funds rate, and I wish I had the graph here, but the Fed funds rate was maintained very, very low, basically through the 90s, through the early 2000s, until 2000, after the global financial crisis, until 2014. That was when the Fed funds rate was raised the first time, or somewhere around there. But the effects of short-run policy over the long run are sometimes hard to discern. But one thing we're looking at now with the Federal Reserve is the consequences to the macroeconomy, the real economy, of keeping interest rates really low, of keeping the federal funds rate really low. And people became more risk tolerant, right? People were willing to borrow much more than they probably should, which benefited the economy in the short run. But the long run consequence of low interest rates, in part, is that it creates this environment of risk, right? And that's in part what led to the global financial crisis, right? Banks, financial institutions were making very risky bets on assets and with their balance sheets that eventually led to some of the big ones failing. And that still is here in a way, that appetite for risk because of really low interest rates for a long time. And so the other reason is, if interest rates are already low, that means that if there is a recession, if there is an economic downturn, and the Fed needs expansionary monetary policy, there's not really room, if rates are low, to stimulate the economy, right? To create an environment where there is expansion because interest rates are already low. This idea of risk, I meant to mention, involves something called moral hazard, which we're not going to talk about a lot. You don't need to know for the AP macro exam, but moral hazard is a phrase used to describe when policy creates an environment of risk takers, and people are willing to take more risk that really acts in the opposite interests of the economy or of society. There are technical limitations to monetary policy. So, like I said, we can only lower interest rates so low, but there have been experiments in some countries, especially most notably in Europe and Germany specifically, and Japan as well, with negative interest rates, which we're not going to get deep into the weeds to, but I'm going to tell you now, yes, it is possible. Yes, it is weird. It's like the Wild West of monetary policy. Okay, the Japanese did it first, and like they do most things, the Japanese are always first when it comes to economic, innovations. But it has not been done in the United States yet. I say yet because it could happen in the future. But even the negative interest rates, they have limitations, right? People don't know exactly what the long-term ramifications of negative interest rates are. So the jury's still out on that. But the Fed can only do so much. And it's interesting, the new tools in the new framework of ample reserves, those are new, right? The Fed created those, right? But they're limited by their innovativeness and their inventiveness with monetary policy. And then, of course, there's the big one, the risk of hyperinflation, right? So the risk of mismanagement, the risk of central bankers not making decisions in the best interest of society, of the economy. And this sort of ties it all together, bringing us back to central bank independence and how important it is so that we allow central banks to make the difficult decisions so that the macroeconomy can flourish, and so that we can have a stable business cycle so that people's standard of livings are maintained and rise, and the economy can grow in the long run. And that really is the overarching goal of monetary policy. And so I hope that you were able to get all the notes. We are now finished with Unit 4, huzzah, and I will see you next time. Take care.